All right, and I think we are at critical mass, so we'll have a few more people joining as we get started, but we'll get right into our presentation mode now. Welcome, good morning, everyone across the country, earlier for some than for others. Excited to be digging into our webinar today on the Task Force on Climate-Related Financial Disclosures. We'll just shorten that to TCFD for the rest of the session to save us repeating the tongue twister over and over. So I'm Hannah Bowen, Network Manager here at the Intentional Endowments Network. And I'm just going to go over a couple of quick logistics and then hand it over to the Mantle 314 team to take us through the session today. So a few kind of basic points as we get started. Participants are starting out muted, but we have the chat function enabled. So please do use that chat function throughout the webinar to ask questions, add observations, add your experiences, and we'll be monitoring the chat as we go. We have 90 minutes for this webinar, a little longer than usual so that we can have some real deep conversation because there are a lot of details to get into, and assuming that some folks on the call have different areas that they want to ask about. So we'll be breaking out into smaller group discussions partway through the agenda. That should be a pretty smooth process technically. You won't need to do anything on your side, just stay logged into the Zoom and you'll be moved into a breakout room for small group discussions. But if you have any challenges with the technology, just shoot me an email that your registration came from or send something in the chat and we will try and monitor that. So before I hand over to the team, for those of you who are new to IEN and our webinar series, the image on your screen is a little bit of a picture of who we are. We're a nonprofit collaborative peer learning network trying to advance the field of sustainable investing through bringing people together in formats like this and sometimes in-person events, not so much these days, and resources. So you can take a look at our website and love to hear more about the work that you all are doing and bringing to the network. But for today, we're gonna hand the mic and the screen over to the team from Mantle 314. They're gonna walk us through the basics of the TCFD and then really dig into what it means for everyone on this call and how you can take it back into your work. So I'm going to hand over to Laura, and I'm going to stop sharing my screen so that she can pull up some slides as well. As I said, we'll start with kind of the presentation mode and then go into breakout groups later on. Great. So feel free to add any questions in the chat, and Laura, over to you.
Great, thank you, Hannah. Welcome everyone, really glad to be with you here today. We're going to be talking about climate change and TCFD. I think everyone's muted their line. If you have any questions, I don't know where that ding dong is coming from though, but I don't think it's on my end, Hannah, but that's okay. So we are really happy to be with here as a new member of the IEN, happy to share sort of some of our thoughts and expertise and have a great discussion today. I think we're going to be giving you a brief presentation overview in the beginning, have some discussion with my colleagues, Joy and Jeff, and then we'll be going into breakouts and then coming back. So really looking forward to all of your input in this. And thanks, Joy, for moving the slides along. You can go ahead to the next slide. So our message today is climate change is impacting business now, and this will continue to accelerate. We're going to talk about what stakeholders want to know and how that's impacting investments, and the TCFD as the leading framework for that discussion. So we heard from many of you in your kind of pre-webinar responses to the survey that you kind of want to know a little bit more about what this means, what the disclosure looks like. So we'll get into some of that today. And then the idea that endowments are both users and reporters of this information. So it's for some of our clients, it's a bit of a shift, having to think about how we actually report align with TCFD and think about the information we're getting from the folks that we are assessing their investment opportunities from. Okay, thanks, Joy. So a little bit just about us and who's talking to you today. I'm the founder and CEO of Mantle 314. We're North America's largest dedicated climate consultancy. Our services really focus around educating and helping mobilize action on climate. And we are an interdisciplinary team of lawyers, engineers, accountants, finance professionals, all helping to translate what climate change means for business purposes. So again, this is not what your business or your investments are doing to climate change. It's really about how climate change and those trends that we're seeing are impacting what you do as your core business or impact. Thanks, Joy. So I've introduced myself. I'm a lawyer by training. I actually started Canada's first climate law firm in 2009. And in 2015, we kind of morphed that into a strategic consultancy. Lucky enough to be joined today and in our working lives by Joy Williams, our senior advisor, who's really been working most of her career on climate related issues and comes to us from being the climate expert at most recently at Ontario Teachers Pension Plan. And she also was the chair of the Decarbonization Advisory Panel of the New York State Common Retirement Fund. So a wealth of information that you'll hear from Joy today. And also happy to have on our team in here today, Jeff Holler, who comes to us. He's actually sitting in London, UK right now. And previous to joining Mantle, he was at Responsible Investor, the London-based sustainable finance and investment news provider. So Joy and Jeff will be adding their insights and kind of sitting in the role of endowments and stakeholders as we go through these discussions. Okay, next slide, please. So why are we here? I'm going to give a 15-minute maybe background about setting the context. So here's a few quotes from Mark Carney, from Larry Fink, and from the head of Deutsche Bank. They're all basically saying climate change is a major financial and economic risk. We need to think about it as such, and we need to start moving to better transparency in the markets. So you may be aware that Larry Fink this year kind of put out in his annual letter that they were going to be looking quite closely at climate-related financial disclosures and imploring all of the companies in which they interact to be disclosing in line with the Tcfd. Mark Carney is actually one of the kind of, I think, he gave birth to or midwifed the Tcfd through his role as the head of the Bank of England and the chair of the Financial Stability Board. So he continues to be pushing this and thinks that we really need to have better transparency in the markets. And then as we move into this coronavirus impacted time we're in right now, it's interesting to us and worth noting that financial leaders are seeing the links between the disruption we're seeing related to coronavirus and what we need to do to react to climate change and the disruptions coming. So from our perspective, we've been finding it very interesting that the asset managers and banks that we've been working with are not backing away from action on climate change and are actually seeing the disruption in the markets right now as more of an impetus to be thinking about climate. So we expect these trends to continue. Next slide, please. And that's because climate change is consistently being ranked as the most impactful and likely global economic risk. This is from the most recent World Economic Forum's Global Risk Report. And admittedly, this was put out before the coronavirus outbreak. But you'll see that the top 5 global risks in 2020 were all climate related. This is the first time that all 5 have been climate related. Something to see that's also in that top right-hand quadrant is like cyber shocks, cyber risk. And most of our clients have a plan for that. Many of them do not have a plan related to climate related risk. So this is like a reshift to make sure that the climate related risks and opportunities are prioritized in accordance with their impact. Next slide. And what does it mean for the need to transition? So just to kind of set the context of why we're actually doing this, we know that climate change is happening. We're seeing the impacts right now, and we know from scientific evidence that we need to deeply decarbonize very quickly. The Paris Agreement is the well-known international agreement having global view to keep the world as under 2 degrees C rise in global temperature. We are not on track for that. This is what this graph says. Our pledged emissions reductions are still well off what is needed to keep the world from seeing a greater than 2 degree rise in global temperature. We believe that the science is so clear and there is inevitably going to be a major disruption in the market to deeply decarbonize quickly. So if you think about this from an economic risk perspective, there is a huge disruption to the market coming if we actually are going to try to keep our world within this 2 degree rise in global temperature, which we need to do for the stability of our natural systems. We are seeing continued focus on the Paris Agreement, although it is a bit of a lag from the coronavirus impact. So the major message here is that this is coming and we are seeing continued requirements to deeply decarbonize and get it to net zero by 2050. Next slide. No matter what the future looks like, the message here is that it's going to be different than today because of climate change. So there's no longer a choice to not think about this or think this as being somewhere in the future, a problem for the future, a problem for another day. We are seeing it's a problem for today, and the future is going to be impacted based on our choices today. If we deeply decarbonize, we may see more stability in the natural system and the physical impacts of climate change, but there will be disruption in our economic system that is now moving away from high carbon. If we don't move quickly to reduce our emissions, we're going to see crazy disruption with respect to the physical impacts of climate change. So that's on the left side of this graph. How will the world look like? We're already seeing, the fires around the world, the droughts, hurricanes. This is going to intensify and will cause disruption itself. So the idea is, as an organization, as investors, how are you assessing your longer term view of where the world is going and how your investments will react to that future? Next slide, please. Just to talk a little bit about the urgency of this and why we're still talking about it in this kind of time where most views are looking at the coronavirus really taking a lot of attention, but really we cannot forget about the urgency of the climate crisis right now. We are in this decade where the science is telling us that we have to have quick decarbonization by 2030 to avoid more than a 2 degree rise in global temperature. And this just shows every amount of reductions we can make now is going to have a significant impact on not having as bad as an impact later. So the difference between a 1.5 degree C rise and a 2 degree C rise is actually quite significant. It's 2.5 times more global extreme heat days if we go past 2 degrees. It's 10 times worse sea ice melt, and it's almost more than half a meter more sea level rise. Now, it's interesting that we're talking about this 1.5 degrees C report here because it's really showing that we're far, far away from the 1.5 degree target. And in fact, we have to really work hard to stay within 2. Some scientists are saying that we're far off from being able to stay within 2. The point here is that we need to work urgently and be asking questions of those that we engage with around what are they doing to prepare for this future. Okay, next slide, please. So every company, investor, bank that screens new and existing investments for climate risk is simply being pragmatic. That's from the president of the World Bank. We know we have to move quickly, and we know that this is actually born a whole new type of work to have transparency in the capital markets. Okay, next slide, please. And that transparency is asking you to talk about risks and opportunities related to climate change. So climate risk is generally broken up into 2 categories. I've sort of touched on this already. There's the physical risk, so the stuff that's happening to the physical environment because of the increased global temperature. So this can be acute and chronic. Acute are the big storms that we're seeing more of, the fires, the hurricanes. The chronic are these longer term shifts, so water availability, resource availability. So that's the physical risk, both acute and chronic, the impacts to the physical environment of climate change. The other type of risk that we've done a little bit more on to date is transition. So this is this move away from a higher carbon economy to lower carbon. This is about legal and policy risks, technology risks and innovation, market shifts, and reputational risks, as we know we need to move to a deeply decarbonized economy. Next slide. We can go more into detail of that in the discussion and talk more specifically about these risks and opportunity, but just wanted to give you a bit of an overview of that. So how are we thinking about climate-related risk and opportunity from a financial disclosure perspective? Well, the TCFD was launched in 2015 and asking, give us a sense of how you're thinking about these risks, disclose it so investors can make decisions about your longer-term viability. And basically it's asking the question, will your house be left standing? This is one of my favorite pictures. It's actually a picture from after Hurricane Michael in Florida. And Russell King, he built this house with foresight that he lived in a hurricane zone. And he was able to have his house relatively unscathed. So if we build our portfolios knowing that we have the climate change equivalent of that hurricane coming, we're in a hurricane zone, can we be resilient? The TCFD is a framework to ask yourself those questions and ask those questions of your investors, investment companies. Next slide, please. And TCFD has really grown in its impact and support. So we're seeing over 1,200 entities supporting the TCFD recommendations, and you'll see most of the support is coming from the financial services sector. And interestingly, we think of this as a quite European initiative. It has traditionally really been led from Europe, but we're seeing more and more growth in North America and Asia of support for the TCFD recommendations. Okay, next slide, please. So what is happening in the finance community as they're reacting to this? It almost is too much momentum to keep track of. We try to keep track of it, but there is something coming out almost every week, every month about new regulations. Just 2 days ago, New Zealand announced that it will be mandating TCFD reporting for all funds over $1 billion and all publicly traded companies that are listed on their New Zealand Stock Exchange. So we're starting to see regulatory push for TCFD alignment. You're starting to see the stock exchanges around the world rally along the TCFD recommendations, and more industry-led and investor-led collaboration for TCFD implementation. Next slide, please. So what is the TCFD? Finally, we're getting there. So we know we need to have consistent and standardized reporting, but we also know that climate change is an interesting topic and will react differently depending on your sector or your type of business. So the framework that the TCFD has put together has these 4 pillars: governance, strategy, risk management, metrics, and targets. And actually has 11 recommended disclosures under those 4 pillars. We're not going to go into a ton of detail on that today. We can certainly provide more information during the discussion or later if you're interested. But the one thing I want to point out here, and then I'm going to go to my colleagues for some questions on this, is governance is the biggest circle for a reason. Often when people talk about climate-related disclosures, they think it's really about your carbon emissions disclosure. And the one thing we hope that you get out of this talk is that is one of the 11 recommendations, the metrics and targets related to your carbon emissions. But the other 10 are about the processes around how you identify risk and opportunity, how you manage that, how you govern it, and how you integrate it into your risk management process. And in fact, the metrics and targets related to carbon emissions may not be the most material for your organization to be concerned with. So maybe I'll turn it to my colleagues for a little discussion on this point. Joy, how are you, in your experience, how are asset owners thinking about the TCFD recommendations? And can you talk specifically about how we grapple with the risk management and the metrics and targets in particular?
Yeah, absolutely. I mean, so the last 10 years I've really been working with the asset owner side. And when TCFD came about, the actual task force, there was lots of asset owners putting their hands up to actually be on the task force because they were struggling with lack of information and then consistency of information. So first of all, there just wasn't any information out there. And then when they did get something, it was in, formats that just weren't conducive for investors at all. So TCFD, I think, was very well supported by the asset owner side. Now, with respect to risk, it was risk management and metrics and targets you wanted me to comment on, right? Right, Laura? Yeah. So metrics and targets, everyone goes straight to greenhouse gas emissions, like doing your investment footprint. And it really has become table stakes across the industry. But what the asset owners realized, this is my pet peeve for the first 2 years, is that it is a backwards looking metric and it is actually not a risk metric. It just tells you a snapshot in time of what your footprint is. But it doesn't tell you if you're exposed to physical risk. It doesn't tell you, in fact, if you think about those physical and transition categories that Laura outlined, the only one it might hit is the policy risk, because large emitting companies could be at risk of being subject to policy. Other than that, it doesn't really tell you much about anything else. So asset owners have now realized that you have to go beyond footprints, even though footprints are table stakes. And that's where the risk management pillar of the TCFD really comes into it, because what we see a lot in the clients that we work with is everyone thinks, okay, risk management means what are my climate risks? Let me do a long list of all my climate risks. And that's not at all what the TCFD is asking for. They're asking for what is your risk process of identifying and assessing those climate change impacts. Because what they're looking for is to understand whether this is like a one-off thing that you as a company or you as an asset manager have done, or whether it is something systematic in your company that you can do time and time again to really get insight. So I would say those are my two biggest takeaways from the risk management and the metrics and targets pillars.
Great. Thanks, Joy. And Jeff, you've been really looking at the regulatory trends in the market related to TCFD. We often talk about governance and strategy pillars being key in that. Can you talk to us about what endowments can learn with respect to the trends that you're paying attention to with governance and strategy pillars in particular?
Yeah, for sure. So I'm gonna cover a lot more of the regulation later, but to focus on governance and strategy, I mean, starting with governance, this is obviously really about understanding how seriously the organization takes climate change and who's accountable for it. And what the TCFD wants to know is, what's the role of the board, what's the role of the senior management in oversight of these climate issues. But it's also about disclosing who's in charge and responsible throughout the entire organizational structure. And I think what we often are seeing is, these are already laid out for ESG risks. Naturally, ESG over the last decade has come a really long way. But what the TCFD is really wanting is that climate change should be explicitly mentioned here. I'd say one thing that we typically see with clients is, and that we recommend actually, is really having a company statement or a position on climate change, as this is going to establish a real clear tone from the top. And that's going to encourage across the organization employees that your organization is taking this quite seriously. So definitely a trend we're seeing, but at the same time, it's an oversight for sure in a lot of TCFD disclosures out there right now. On the strategy side, again, you mentioned TCFDs, what they're wanting you to do is disclose the risks and opportunities you've identified. And it wants to understand, how you plan to make changes in your business strategy and planning to account for these. So I think the one thing to point out is that with climate change being a short, medium, long-term risk, the TCFD definitely stresses that you've identified risks and opportunities across that time horizon. And I think that's, the one thing we often see is sort of the quality of disclosures on climate risks is there, but on the opportunity side, it really is being overlooked. And that's definitely something that we stress as a firm is, you also need to be looking at the opportunities here, because certainly on the transition side and on the physical side and adaptation, there are significant opportunities. The other thing I'd just lastly point out around scenario analysis, which is a key part of strategy. Here the TCFD, like you said, looking for your resilience across different climate scenarios. The CPA study that we did, we found that only 5% of companies had applied scenario analysis. And I think the key here is that a lot of companies, investors are really waiting around for, a really good quantitative tool to help perform scenario analysis. But I think what we would recommend, certainly in terms of getting started, is there's a lot of qualitative scenarios, which can be a good place to start, understand the narratives, how this could impact your business. And I would just point out Ontario Teachers Pension Plan has a really nice qualitative scenario analysis outlined in their TCFD report.
Great, thanks, Jeff. And yeah, I think that the mention that you made of opportunities is a nice segue. Joy, if you could put it to the next slide, which is another pull out. We just put it in mantle colors, but this exact graph is in the TCFD recommendations. So what this says is, here are those transition and physical risks that I introduced a couple slides back, but also here are the opportunities related to resource efficiency, energy source, product, services, markets, and resilience. How do both of those, buckets of risks and opportunities flow through to your financial analysis? Is asking for some rigor on that through strategic planning and risk management, also through the cash flow financial impacts that are borne out in your cash flow statements, in your balance sheets, in your income statement. So let's put this in context. A real estate company that is saying, geez, I'm using a lot more air conditioning, and we're having we have to really keep our monitoring and maintenance up because of the air conditioning in our building. Or for instance, we're even seeing more ice. We're having to use a lot more salt because we're getting more ice thaws and starts. Then they think about, well, is that a trend? How does that relate to climate change? Is it such an important trend for us that we need to be making note of it and putting it through our regular processes? Flooding. How many times have I seen flooding occur? Do I need to really take a more strategic approach to that, and knowing that I probably will see more flooding in the future? So that's just sort of in the real estate context, some examples. So hopefully that gave you a little bit of a crash course on TCFD. Happy to answer more questions. And I think Joy said, and Hannah as well, if you have questions, feel free to put them into the chat and we can take those as we go. Kind of want to shift gears now from just the general overview into thinking specifically for endowments. So I'm going to be asking my colleagues some more questions on this. And Joy, if you want to go to the next slide, we can be there. So what does TCFD actually mean for endowments? Joy, Jeff, I don't know who wants to take this one first, but why should endowments care?
I'm happy to take it, Joy, if you'd like.
Okay, sure, start off.
Okay, so I think really here there's kind of three important things that I would probably talk about. So the first thing would be that there's increasing reporting regulations on investors focused on climate disclosure. And some of these are even referencing the TCFD as a framework to follow. Just to give you an example of that, I mean, the UK Pension Schemes Bill, which is currently going through Parliament, will require climate change risk governance and TCFD reporting from occupational pension plans with more than £5 billion under management by the end of 2022. And then funds with more than £1 billion will be required to disclose by the end of 2023. And they're already talking about fines being imposed for non-compliance with that. In New Zealand, just earlier this week, we saw that they made TCFD disclosures mandatory for all asset managers of registered investment schemes. And that applies to anyone above $1 billion in assets under management. That's on a comply or explain basis. So that's obviously worth pointing out. So that, that naturally means that companies will be able to explain why they haven't been able to report under all 11 TCFD recommendations, but you're probably going to see that become stricter over time. Obviously, these are these are aimed at public sector pension plans and asset managers. So there's obviously a lot more government oversight there, and endowments are likely to potentially be further down the road. Even if not, it's pretty clear that industry standards are going to continue to develop. So even if regulation doesn't hit you directly, it's certainly where the industry is going, and regulators are well aware. The other thing I just wanted to point out was earlier this week, the Commodity Futures Trading Commission's climate-related market risk subcommittee, which you've probably heard of, they issued a report with about 53 recommendations for financial regulators on climate risks. And in that document, they referenced the TCFD 65 times. And what they say in it is that financial regulators should incorporate climate risks into their mandates and develop a strategy for integrating these risks into their work. So it's something that obviously we're seeing regulators be adopting, and by name in the TCFD. So definitely one reason why it's incredibly important. The other thing I'd point out is around changing interpretations of fiduciary duty to include management of climate risks. So we've seen recently legal studies come to the conclusion that fiduciaries have a duty to consider material climate risk when making their investment policies and decisions. And with governments, regulators, the legal system, they're all coming out, they're all communicating the financial risk of climate change. It poses a pretty hard, it's pretty hard for fiduciaries to ignore. And we're also seeing pressure on supervisory bodies to clarify the role of climate change in fiduciary duty. So just to point out a few, the EU Commission, as part of their action plan on sustainable finance, they're looking to clarify that fiduciary duty includes sustainability risks. That same CFTC report that I just mentioned from the US, it said US regulators should clarify existing regulations on fiduciary duty, particularly around climate risks and the appropriateness of integrating factors into investment. And then from a Canadian perspective, obviously we're a Canadian firm, one of the recommendations of our Canadian expert panel on sustainable finance to the Canadian government was to clarify the scope of fiduciary duty in the context of climate change. And obviously the TCFD really comes into this as it can help fiduciaries in demonstrating their compliance with their fiduciary duties. The last thing I'll point out very quickly is really that we're seeing, this is not just another reporting standard. So we're seeing existing ESG reporting standards like SASB, GRI, CDSB, CDP. They're all converging around the TCFD, and they're all providing guidance as to how their standards can be used within a TCFD disclosure. So those are hopefully three things that really highlight to you how TCFD is really rising up in importance across a variety of channels.
Okay. Yeah, thanks, Jeff. I think it's so interesting, the coalescence we're seeing around TCFD, but also the continued push for governance, like when we're talking about fiduciary duty and asking the questions. And I think the role of endowments, and this is what I'm hearing from you, interested in Joy's take on this too, in asking questions can't be understated. Because as you continue to grapple with this, asking the questions, both within your own organization and to those that you interact with as an investor, is such an important role right now as we're kind of trickling down what is material, what should be considered, what are the right metrics. So we're not at a stage where we have the answers to this, but we're certainly at the stage where we know it's important and the questions are absolutely critical. Joy, what's your take on why should endowments care?
Yeah, and I just want to pick up on something that Jeff said is it's not just regulations, it's the underlying industry standards. So like the CDP, et cetera, they're not regulated at all, but they're so widespread that as these frameworks adopt the TCFD, it just means that there will be more and more information in the TCFD framework out there. And that is something that's continued on from the asset owners as well. There are so many asset owner initiatives right now. And just as Laura, you said, there's something new coming out every week. That's literally the case on the asset owner side as well, that are pushing climate management in various ways. So everything from engagement, so climate action 100 plus, which does have disclosure as one of the asks, to different frameworks for the portfolios. What this is doing is pushing TCFD down to the investment companies and to the asset managers. So where endowments are going to come in here is, one, knowledge of TCFD and climate change is at an all-time high across members of your endowments, beneficiaries of pension plans, as well as the companies. So the information, once the information is out there, you definitely can't ignore it. And so it's about asking the right questions to make sure you're getting decision useful information and not just greenwashing. And then the flip side of that is, because the asset owners are banding together, the large asset owners are trying to develop tools and different frameworks. And they're doing this so that other investors can pick up these tools, because not every investor has the resources to develop all these things from scratch. So the large guys like the Caisse de dépôt from Quebec, the BlackRocks, the Alliances, and Natixes, the really large investors are putting resources to this so that mid-size level investors, asset managers, smaller investors will have ready-made tools. And that will shift the whole finance industry. And I think that's where endowments can sort of both ask those questions, because the information is going to be out there, but also to have the advantage of using what other asset owners are developing today.
Yeah, that's really a great point. We're seeing with our clients, a lot of their action around climate is these collaborative efforts. And they're certainly saying, some of the banks we work with in particular, they're saying, you know, unlike most of the things that we see as being competitive, this one's just so important for the stability that we want to share more than normal. So I think we can all really benefit from that sharing culture that we're seeing. So this seems kind of a little high level. I know that many people might be thinking like, well, what does this mean for me? How can I actually use this? So Jeff, like, how can endowments actually use TCFD, and what's expected of them as far as participation and use?
Yeah, definitely. So I'll just point out, I think I will definitely come at this from a point of view that endowments as users of TCFD disclosures, just to clarify that for everyone. And I think Joy will probably follow me by talking about endowments as reporters of TCFD disclosures. So focusing on the earlier one around how endowments can use TCFD disclosures. So this is really going to depend on the fund structure. But the first thing I'd say is, for endowments who outsource to asset managers or outsource CIOs even, the TCFD can really be used as a tool to assess their climate awareness and their capabilities. And you could do this by integrating TCFD related questions into your RFPs, your asset manager due diligence, selection, monitoring. You could ask questions around, do they disclose in line with the TCFD recommendations? If not, do they have plans to do so? And really, regardless of if they are providing climate disclosures, you can also utilize the TCFD's content to be asking them questions. And you can also, we've seen asset owners integrating questions like that into their RFPs. So again, these could be questions like, are climate risks and opportunities integrated into their risk management frameworks? Can they explain how climate-related information has potentially impacted any investment decisions? Do they advocate themselves for their portfolio companies to provide TCFD disclosures, or is it a part of their engagement strategy, for example? So I guess, the takeaway there is really, regardless of if they're providing TCFD reporting, the TCFD is still a framework and a helpful tool for you to understand how climate change is being integrated into your fund's investments. To add to that, so for endowments who are doing most of their management in-house, perhaps, I know that's probably maybe only a select few, some of the bigger ones, but the TCFD can really be a tool to integrate into your company engagement activities as well as your investment analysis. So on the engagement side, the TCFD framework can be used to assess companies' management of climate-related opportunities. Again, going to the governance, you can sit down with management and really ask them these sort of questions, or you can collaborate with other investors on things like that. And there's certainly active organizations on that. And really, whether companies are providing TCFD, you can ask these questions to understand how capable management is in providing answers. And typically what that's probably going to do is, have knock-on effects of, I'm getting these questions from investors, so naturally we need to go back in and figure this out. And that's absolutely happening in companies, and it's absolutely happening with asset managers as well. They're getting these questions from their clients. And like I said, these questions could be around, is climate change receiving appropriate board and management attention? Are they understanding how climate change impacts their business, their strategy, their financial planning? Does the company collect climate-related metrics? So again, really just a framework, a tool. On the portfolio management and investment analysis side, PMs and analysts, again, can use TCFD disclosures. We're going to have to say it a lot on this webinar, to assess and compare companies on their management of climate risks and opportunities. And this would certainly be helpful, definitely to start within more exposed sectors with higher climate risks, such as mining, energy, agriculture. And just to tie this back, by doing all this will feed into what Joy will talk about in a second, but this also helps to inform endowments in their own TCFD disclosures on the reporting side. And I'll obviously let Joy talk about that now.
Sure, thanks, Jeff. Yeah, there's definitely a theme from the asset owners that I've worked with that says, if we're going to ask other companies to report according to the TCFD, then we need to think about what we're disclosing. Many of the larger investors are already putting out a sustainability report or responsible investing report, or integrating it with their annual reports to their members. And that in large part is also because of the interest from the beneficiaries. So there's definitely a theme there where, and TCFD, the task force itself, said that this is something that they recommend for all financial organizations, whether or not you're a public company. So certainly there is an element that as an endowment, this is, if you're going to say something about climate and how you think about climate, doing so within the TCFD framework is a good idea. This framework is now being readily recognized. And as I think we've all said on the intro part of this, is that the 11 recommendations are pretty comprehensive. So if you go through the 11 recommendations, you'll have a pretty hefty disclosure. What I usually say to a lot of investors who are maybe newer to this, and of course there's always concerns about when you're saying something publicly, is even if you decide to not disclose in the end of the day, just the TCFD framework is a great way to assess your own organization. So if you take those 11 recommendations and run through your own organization, just say, can we answer this? Do we know what we do? First of all, it's a great discovery exercise. This is what we usually do for our clients, because there's usually a ton of processes or thinking buried in the company somewhere, but it's not called climate change. And it's not sometimes not even called ESG. But by going through these 11 recommendations, you start to discover that you probably do more than you think. And then at the end of the day, you have a better picture of where you stand as an investment organization, coupled with what Jeff said, talking to your asset managers or your OCIOs. You'll have a much better understanding of where you stand, where the gaps are, and then you can decide if you want to disclose or not. That's really sort of the end output. I actually find TCFD is much more useful as that tool, the assessment tool within an organization. And then the disclosure is just like, that's a nice afterthought after you've done the whole assessment.
Yeah, I think that's really interesting. And we've been fortunate working with a lot of clients who come to us sort of with their tail between their legs and say, I don't think I'm anywhere on this. I feel really bad. Where are we? And if they're a well-run company, they usually actually have a lot to say, even if they didn't put it in that climate change. So you hear a lot recently about this climate lens. That's what TCFD is really doing. It's asking, let's put this climate lens on your existing practices and just be intentional about putting in climate change into your good management practices. If they're doing well on controlling costs, if they're doing well on strategic planning, they probably have quite a bit to say on climate. So I think that is a sense of something that folks can feel sense of comfort, being like, it's not actually so far off from just good management. And so maybe that leads to, Joy, I'll start with you this time. What do you do to get started as an endowment, and you know that you need to do something about this? What are some of your suggestions for what you're seeing as good first steps?
Yeah, well, I mean, even just attending webinars like this, there are a number of resources out there. I mean, we do, Mental does actually do training, but there's a number of resources out there just to learn about what these 11 recommendations actually mean. So as I mentioned in the beginning, everyone thinks risk management is one thing, and we do see that being confused very often. So to actually dive into what these 11 recommendations mean and to be educated on that so that you can do that self-assessment, take that inventory of what you're doing in the in your own organizations. But the other thing which we've touched on throughout this is that there, as Laura said, this is not really a competitive space. Reaching out to different peers and other asset owners who maybe are part of some of these networks. Most people are actually really open about talking about the challenges, where they are, how they are using the TCFD. The Investor Leadership Network, which was a G7 initiative begun a year or two ago, they've actually put out 2 reports so far, and it's all about their own experiences with certain parts of the TCFD. So I think the first report was on scenarios, I think, or the second report was on scenarios, and the first one was potentially a general implementation. So reaching out to these organizations and just talking with them is another great resource just to get started. And then if you are actually ready to report, then again, following those 11 recommendations, taking a look at what peers are doing, that's always a popular thing that we've been asked to do, is another place to get started if you think that you're really moving towards reporting.
Great. And Jeff, same question to you, but as a user of this information, how do you start digging in?
Yeah, so as a user, I think there's definitely some areas where you can probably start doing some immediate engagement. I would reiterate Joy's point around just starting to read more, getting training on the TCFD, because from a different perspective, this is also going to help you in having your external conversations about it. And then sort of feeding into that in terms of having those external conversations, I think that is kind of the immediate stuff that can be done. So again, going back to, if you have an outsourced CIO, you can start asking them questions about, are they familiar with the TCFD? Are they providing any climate disclosures? Is it being integrated into their manager selection process? If you're doing the manager selection yourself, again, begin to embed that in your process there around asking them simply, do they support the TCFD? Are they already providing disclosures? How aligned are they? And that's kind of where that education and training might feed back, is being able to have a better assessment of where they are. Again, using an investment consultant, same thing. And then I would just finish off, if by chance you are managing assets in-house, I think going back to training, getting portfolio managers and analysts training on the TCFD so they can understand what they're looking at, how to really use the TCFD as a tool to compare and assess companies. These are all things that I think are definitely short-term goals around the TCFD, and that they can start to bring up in their conversations with companies and even on their teams. Just, again, it's about, to Laura's point around climate lens, it's really about putting this on the agenda throughout the organization. And I'll finish off by the last thing being around collaborating. There's definitely a ton of climate-related collaborations out there. There's places to get involved, certainly as smaller asset owners. I know it's tough to have a big voice at the table, so definitely that's where collaborations can come in on things like this, and talking to them about the TCFD, and if you're investing in similar funds and or similar companies, all these things like that can definitely be put to work.
Yeah, absolutely. Thanks, Jeff. It's really interesting to think about the importance of collaboration in this, and the urgency to address the climate crisis is going to take us all being creative and innovative and working together. So I think that's a huge part of this, to find the solutions forward. Joy, if we could switch to the next slide. We're about to go into our breakout rooms, as Hannah's put into the chat. And we're thinking about structuring the discussion. Hopefully all of you have some thoughts, and we don't need to kind of monopolize what we're going to be talking about, but here's some discussion points for both the breakout and then when we come back. So, are we experiencing pressure to incorporate climate change in the fund's investment strategy? Sorry, let me make a note here. When we go into the breakout rooms, we won't have these slides up. So if you want to make a note of the discussion questions and the ones that you would like to speak to, that would be great. So the first one is around pressure. Are you experiencing it? Let's talk about that. Let's open up that discussion. Would you like to experience a bit more of it because you might need some internal push and you're not getting it? So let's talk about that, the importance of pressure, and are you feeling it? The second is peers. Could you have these conversations with your asset managers and your investment companies? We'll talk about that in the conversations that we're actually having. And then the third discussion question, are you aware of climate-related risk and opportunity being actively identified and managed within your organization? So hopefully we can share some learnings on that. And thanks, Hannah. I see that you're putting that into the chat for us. Okay, I'll hand it back over to Hannah to maybe break us up.
She's probably still typing out that last one.
I was going to say, yeah, typing and muting and unmuting at the same
sorry.
time are a challenge. Awesome. So thank you for the overview, the discussion. We've dug into all the way down to how you can get started. So hopefully everyone on the line is ready to dig in and get started. So I'm going to hit open discussion rooms, and everyone will be moved into a sort of smaller Zoom room. It should look about the same. One of our experts will be in there with you to guide the discussion. You'll have a button to send a message to the host. So if you have any technical issues, use that button and let me know. If you're listening on the phone, you should move over into a new room automatically as well. You shouldn't need to do anything. And then we'll be in discussion rooms about 20 minutes, and I'll close those out. You'll get a warning before it closes out and we come back to the main presentation. I will do that now, and you will reappear momentarily in a smaller group. All right, welcome back, everyone. Everyone's computer is making its way back over. Looks like all of our rooms are closed and we're back. Nice to see everyone on screen, a lot of video on. I hope those were productive breakout sessions. And Laura, I don't know if you want to take us through a debrief and continuing the discussion.
Sure. I feel like our group just scratched the surface, so hopefully others kind of want to continue on. Our group was just kind of getting to know each other and to talk about how this is, but I think the general overarching view I got was it's a learning time. About TCFD, it's how does it fit into everything else we're doing, and many of you are doing amazing things. I was really interested to hear about some of the amazing things that my group was doing, and I wonder if that's what we felt. Is this really a learning time, and how are we actually engaging with TCFD? And it's really about thinking about some of these risks and opportunities in a more consistent way. Joy, Jeff, what came up in yours?
Yeah, in my group, I mean, it raised the age-old question of TCFD, GRI, SASB. So how do we know which one? And I love somebody in my group, I think it was Mark, said what we say all the time, which is just pick one and get started with whatever makes sense to you, because you'll discover as you go. And it's really in working with these things that you figure out what might work best for you. But the other thing is it's data. It's everybody's looking for more data to understand what it really means to their organization. And I was shared with my group that when we did the review of climate disclosures last year, the quality of the disclosure is still ranges. It still ranges. So that is still a work in progress for sure.
Yeah, I can just touch quickly. Interestingly, so we didn't talk about SASB or GRI in our group at all. We had Celine, which was really interesting, and she's been involved in trying to pressure her school's endowment to take climate change seriously. So we spent some time giving her some advice on that, which was really great. George, you finished off the conversation with a question we could probably talk a little bit more about, which was around where do you find TCFD reports, and talking about how I wasn't involved in the CPA study like Laura and Joy were, but from what I understand, these are really being found everywhere in terms of existing ESG reports, standalone TCFD reports within the financial reports. So that's definitely an issue, but also I believe the TCFD does recommend it's in the mainstream financial reports. Another thing I thought we discussed was really around, it seems like people have done good work on ESG, and there's probably some assumptions that, you know, climate risk is integrated within that to some degree. But I think clearly we have to sort of move to a place where what the TCFD is really asking is to kind of separate climate out of that explicitly. And it seems like there's definitely more work that needs to be done on that. And hopefully the TCFD can continue to be a helpful framework for people.
Mm-hmm. Mm-hmm. Yeah, I am very interested in this group's, and I know we're in a now more manageable group for a discussion. So I think if you can unmute yourself, if you wanted to participate in this discussion. But my question to all of you who've been doing great work in, oh, Joy, we can see your screen, I think.
That's mine. I just wanted to add one thing that we
great,
talked
yeah.
about in our breakout group. This is Paul Herman from HIP Investor.
Yeah.
So hi, everybody who we haven't met yet. And one thing that's been really helpful in getting as many people on board as possible is communicating this global temperature rise to a human body equivalent. So if we say the Earth is our body temperature is 98.6. And so if we were to add 1.5 or 2 degrees Celsius, or in the US, that's 3 to 4 degrees Fahrenheit, you would have a consistent fever of 101 to 102. And what Natixis has said on the record is that investing traditionally is investing in a 5 degree Celsius world or a 10 degree Fahrenheit world. And so if you had a temperature of 105 to 109, you would have Ebola or you would die. So to the extent we ever want to get like really in people's faces about this is meaningful, this is what your body temperature would be all the time.
Right. And when we talk about this with our clients too, it's like scenario analysis. So let's do scenario analysis with like 2 degree and then like more than 2 degree. And it's like, how do you actually even do that? Because that's like living in bubbles. I don't know. So that's the challenge that we have with a lot of these scenario analysis, because there's like a disconnect between like physics reality of what the world can sustain from that type of temperature rise. So thank you for that. That was really great to talk about. And how are others having these conversations? Love to hear from any of you and what you're hearing in your conversations. We talked a little bit about the...
Well, I'll add one more thing about science-based targets. So this is another, there's companies that have science-based targets. So like Novo Nordisk has 100% greenhouse gas reduction by 2030. Or Levi Strauss, the jeans company, has a 95% reduction that they're on the record for. So there's an actual glide path from today. But even if we say, okay, let's eliminate all the carbon in 10 years, that's one type of a glide path. That's an 8% reduction every year for 10 years. So it's not just like 8% next year. Okay, we can crank that out, but 8% every year compounded leads to 100% greenhouse gas reduction. So these are like the innovation sparks for business people, but also for investors. And then you can track that glide path over time. Are you ahead or behind? And some of the challenges that come up from an investor point of view, and just from a human point of view, is NRG, the energy company, has reduced its carbon profile by half because they've divested. But those assets have gone somewhere else. And so just like if you divest private prisons, publicly held private prisons, somebody else is going to operate that prison. 75% of the carbon reserves in the world are held either by governments like Iran, Russia, Venezuela, or by private companies. So, so that's the other sort of pressure we need, is how to address the full system beyond just the portfolios that we hold. So we can isolate the financial risk from our portfolios like the IEN endowments do, but how do we solve the whole system? And that's a challenge.
Very interesting, and that's where TCFD overlaps. And Joy, I'm going to come to you because I know you spent a lot of time thinking about this divestment issue in your role as the chair of the Decarbonization Advisory Panel for the New York State common retirement fund, and this idea that divestment is not necessarily the right answer for those of us who are wanting to move in a more sustainable direction. So Joy, I know you spent a lot of time thinking about that. Would love your thoughts on that question.
Yeah, exactly, because the panel was named before we really got together, so we couldn't change the name of the panel. But we had to actually go in and define what that kind of pathway meant for them. So when we, as the panel, came back to them and said they should be 100% sustainable, we had to define that sustainable meant that in their portfolio, there was a portion of the portfolio that really wouldn't have much to do with climate. I mean, there are investments out there that climate is not one of the top 5 things that you're talking about. Then you have investments that really support the transition to a low carbon economy and are directly linked to that transition, whether it's moving to cleaner energy sources, cleaner transportation, etc. And then you've got a bunch of stuff where it would help to accelerate the transition, even if it wasn't a direct mitigation of greenhouse gases, etc. But the point was they didn't know what was in their portfolio. So even having investors go in and take a look at what they had and think about it in this way was a more useful discussion to have than just to say, let's just divest of a whole bunch of stuff. Because to Paul's point, it's those divestments go somewhere else and you're still left with a bunch of other stuff that you don't know is on the right or reasonable glide path to a low carbon economy. So just this idea of actually looking at what you own and identifying what the risks and opportunities exposure of your portfolio is was something that was pretty new to the New York State. And those are some of the same principles that Tcfd, right, are espousing, is really make sure you understand what your risk and opportunity exposure is, and then a pathway forward.
Mm-hmm. On a related note to both that comment and Paul's, I just wanted to highlight, we're seeing more conversations around the concept of net zero portfolios. So just like every underlying company can be on those glide paths, what does it mean for a whole portfolio to start to do that? And Harvard and Stanford have both made commitments to go that direction. And I think that at least gets a step closer to what Paul was talking about on the systems level, maybe not all the way there, but for some universal owners maybe, and looking at, the role of policy and government in getting there. So we're going to have a lot more kind of programming. And Hannah just put a link in the chat about some upcoming events. One of them will be in a couple of weeks with the Net Zero Asset Owners Alliance, talking about this approach. And Tcfd is a central component, I think, to that sort of net zero portfolio approach. So,
yeah. That's great. I wanted to come back to something that both was in our discussion in my group and what Jeff was saying around where do you find this disclosure, and then link that to what can we expect of boards and governance, which is, Sarah, you kind of were like talking about that in our group. You were talking about like leadership and almost like the strategy and fiduciary information, and something that I think Tcfd does really well that I want to make sure we've made clear here is sets up those high level conversations, like sets up the conversations for how is this governed? How is your board getting this information? It's asking you things like, what is your process for identifying climate related risk and opportunity, and how is that integrated into your existing risk management processes? And then what is management's role in dealing with that information? What is the board's role in hearing about that information? So that's really like the bulk of what Tcfd is asking for these process-based just disclosures on the process, not just on the numbers of your targets and how you're getting there, so that there's accountability in the system. And as part of that, as you all know, boards' roles are often related to disclosure, right? And like they are supposed to be checking whether disclosure, and a new legal opinion out of Canada, but the law is very similar between Canada and the US, was talking about boards and their potential liability with respect to not asking the right questions and not managing this properly. And I wanted to point out that whether or not you disclose something is often an objective standard. So the business judgment rule is probably not applicable there. Would it be reasonable for someone to want that information? right? And a board's supposed to have that reasonable person view on the governance of an organization. And we've just talked about these massive shifts that are going to be needed to stay within a habitable planet. Would it be reasonable for that information as specific to your company to be disclosed? So if we frame the discussions with our stakeholders along those lines, I think it's very interesting. And where are we seeing this disclosure? So absolutely, TCFD recommends that it's going in your required regulatory disclosure. But on the flip side, they also say not only public companies need to do this. So many of you may not have those types of regulatory disclosure requirements. It should be findable. But we are seeing it right now, not really only in the regulatory disclosures. Often there'll be a separate TCFD disclosure report. Often people will put a lot of this in their CDP. Some people already mentioned the CDP report, which is now aligned with TCFD. And then often we'll actually find it's starting to come more and more in the annual reports and in the regulatory required filings. And that's certainly the push that we're seeing from both TCFD and the regulators. I don't know if anyone else has something to add on that front.
I'm just curious if you guys have a recommendation of like a really good report that might be a good example.
Oh, like a best practice of a company?
Yeah, just to check out and see how they're doing.
Yeah, I'm sure Joy will be racking her brain and has them at the top of her fingertips, but Jeff already mentioned the teachers pension plan report. They're seen as leaders, and some of the banks, so BNP is really well known for that. Any other suggestions from the manager?
Yeah, I was going to say Ontario Teachers, but on the banking side, I'm going to butcher the French, but Société Générale, the French bank, has very good disclosures. There's I think it's the European EFR, I can put it in here in the chat, but they did a report looking at disclosures across some of the leaders, and that's worth looking at. That's a European government agency.
Yeah,
and just logistically, in the next day or two, we'll send out the recording of this webinar and can add additional resources. So if folks have ideas of best practices or great examples to share, and we can compile any from the full report team as well.
Yeah, I was just going to share, Tech Mining has a really good one around their scenario analysis, as well as Entergy has a very comprehensive sustainability report where they incorporate TCFD. So it's an example of where you can report on lots of different things, and then they have an index within their report that says where you can find all the TCFD portions of it.
Yeah. I would also encourage you to see there's status reports that TCFD has put out themselves, and what they do is they're not necessarily saying that these are examples of good disclosure, they're saying these are examples of disclosure in relation to it, but they've pulled out, I know that they pulled out some banks and some energy companies in various sectors, so TCFD status report will give you some good examples. And what we're finding is like you're often going to see a really nice disclosure related to like one of the categories from some of the banks, but having like a really good example from one company where they nail it on all the 11 recommendations is probably a lot less likely. So it's probably best to go pick and choose using some of those aggregators that are out there, like the TCFD status report. Any other questions, comments? I'll open the floor up again.
This is Sarah. Yeah, I told you, Lauren, one thing that I had another meeting that went way over, so I missed the first half hour. But can you, unless you've already talked about it, a little bit more from the asset owner working with their investment consultant or financial advisory firm, how best to move things forward as presumably it's the consultant who's doing that more direct interaction with the managers, who's having that more direct interaction with the companies. Is there any guidance on just that relationship and what works? And because this is a huge space, but
yeah, we get that question a lot, like how do you engage with your managers? And Joy, I'm going to throw it to you in a second, but what we've heard from our manager clients is sometimes the questions aren't educated either. So it's hard, like you're getting this question, show us that you're aligned with Paris, and by the way, we still compensate you based on the benchmark. right? And so we need to have these like more holistic conversations with managers around this, because as it was just mentioned, the indexes and the benchmarks are not sustainable with
Exactly.
the Paris Agreement. So this education and asking the right types of questions, we're seeing that's where a lot of the action is. And I think Joy has some probably pragmatic advice there as well.
Yeah, because we're seeing the same thing on the consultant side, is that if you go through a consultant, they're not educated on it either. So they can't actually pass your questions on to the managers. So if you can engage directly with the managers, it's better. If you can't, then one of the things which we've touched on and why we're emphasizing tone from the top is if the asset owner has a set of climate change principles, just what you believe. Like, even if you just believe climate change impacts your investments and your return, and you want to know what the managers think about that, that actually is really helpful, because you can publish the principles. And I know New York State has done this. I know some others have done it. And just sending that out in itself was a discussion starter.
Okay.
But it is a process to actually come up with those principles. Investment organizations can take up to a year just to even have those discussions about, you know, what do you put in the principles? Do you put it in the investment beliefs? Do you have something separate? But once you have it, it's a great tool for the engagement with consultants and with managers.
Thank you for this great discussion, everyone. It's been a really great time. We're open to continuing this. I think we're at the end of time today, though. So it's been really insightful for us, and happy to continue conversations offline.
Awesome. And a huge thank you to Laura and Joy and Jeff for leading the conversation, but really to everyone for making it an active and small group conversation as well. And yes, as Laura said, want to continue the conversation, especially I heard the word collaboration come up a lot, and kind of the collective pressure of endowments, of consultants and OCIOs, of managers. And so that's what our team is here to help facilitate and want to help with. So keep in touch, and we will definitely keep the conversation going. Thanks all for joining today.
Thanks, everyone.
Thank you so much.